Welcome, everyone, to the Adjusted for Risk podcast. This is our very first episode of what hopefully will be many, many more. So thank you so much for listening and joining and being a part of what hopefully will be a very exciting and entertaining series of podcasts. So let's go ahead and get started here. Do you all recall we're going to start with ESG investing. And many of you may remember socially responsible investing. It was somewhat popular in the early 2000s for investors who are looking to invest in their beliefs and values. Performance of SRI funds was never really that great, especially compared to just your typical investments that included tobacco, oil, and firearm companies, as those companies really outperformed when SRI funds were really gaining in popularity. Well, SRI funds have evolved really into ESG investing, or environmental, social, and governance investing over the past decade or so. And the theory for ESG goes something like this. There's growing belief that environmentally conscious companies that manage their internal and external relationships well and maintain strong corporate governance will experience sustainable growth into the future while reducing risks. So today's investors now are more willing than ever to invest in their beliefs, values, and the matters that they are most passionate about, in hopes that it will make for a better tomorrow, right? And I think everyone can agree on that if they can do something to make for a better tomorrow for their kids and grandkids, they're willing to do it. So this is resulting in huge growth and popularity for the investment style. It's no longer just a niche investment. It's a true investment style, is investing in ESG. According to EPFR, ESG funds or U.S. equity mutual funds with the ESG mandate, they've experienced consistent net inflows to the tune of over $130 billion over the past 5 years. And during the early years of ESG, there was really this stigma attached to the investment style, in a large part due to the underperformance of SRI funds years ago, that investors are compromising investment returns in exchange for investing in their values. But that stigma is really shifted recently. And all you have to do is look at returns. So if you, over the past 5 years, if you compare the iShares, it's the largest ESG ETF out there. It's the iShares ESG Aware MSCI USA ETF. A little bit quicker, we use the ticker ESGU. If we compare that ESG ETF to the very basic S&P 500 Spider ETF, or SPY, the returns are very attractive for the iShares ESG ETF. In fact, over the past 5 years, the iShares ETF returned an annualized 16.67% compared to the Spider's 16.37%. So there's outperformance over the past 5 years. As for risk, the risk is a little bit different story. iShares has a standard deviation of 15.77 compared to Spider's 15.4. So when you take it all into effect and roll it all together, the risk-adjusted returns, or the Sharpe ratio, for those two ETFs are identical at 0.99. So that stigma of you're investing in ESG, you're going to forego some returns, really no longer exists today, as the returns are very attractive now. But recently, so when I was looking into this, the performance of ESG, I looked a little bit deeper, and by doing so, I uncovered a trend, and it's not entirely surprising, but the trend became very clear when you look across most of the ESG funds, popular funds out there. They have high exposures to technology or the technology sector, and if you look at the top 10 holdings, a lot of these funds, especially that iShares ESG ETF. The top 10 holdings of these funds look a lot like the Spider ETF and the triple Qs, QQQ ETFs, which is the technology sector or the NASDAQ ETF. Take it a step further, the iShares ETF has a 27% weighting to technology sector compared to the Spider's 25% weighting to tech. Meanwhile, 80% of the iShares top 10 holdings have overlap. Big tech names like Apple, Amazon, Tesla, Alphabet, and NVIDIA are all common names in the top 10 holdings. So that brings us to correlation. The correlation between the iShares ESG ETF and the Spider 500 ETF is 1. They're perfectly correlated. Furthermore, the correlation between the iShares and triple Q is almost perfectly correlated at 0.93. So when you look at that and you look at the holdings and you look at the relationship between some of these big ESG funds and just traditional broad market indexes or ETFs, the strong performance of these ESG funds really shouldn't come as a big surprise when you consider that overweight the technology sector, which has been the top performing sector over the past 5 years. So, however, despite that large weight of tech, the ESG ETF still behaves a lot like the Spider ETF, and that is evidenced by the correlation of 1. So the question really remains, and after doing this research, is the performance of ESG funds driven more by the belief that environmentally conscious companies that manage their internal and external relationships well and maintain strong corporate governance, will they experience sustainable growth in the future while reducing risk, or is the performance driven more by the performance of big tech in the overweight to big tech? So while I believe that ESG has benefited from the large weighting in tech, I still believe a strong or a large portion of their solid performance is still attributed to the theory that environmentally conscious companies that manage their internal and external relationships well and maintain strong corporate governance will experience sustainable growth, along with growing popularity in this space. Like I said, it's no longer a niche investment. It is an investment style. We're going to continue to boost performance. But with that being said, I think it's very important, if you're looking to invest in ESG, that you look under the hood and see exactly what they're investing in. Does it align? Do those underlying investments align with your values and beliefs? And you cannot overlook that overweight to the technology sector. That must be considered when constructing an investment portfolio. So let's move along here. Really, there's a lot going on, obviously, in the world. With policies and macroeconomics, geopolitics, just there's a lot of noise out there. But I want to focus for a little bit on fundamentals here real quick. Q1 corporate earnings season has kicked off. Estimates are calling for year-over-year earnings growth of around 4.5%, which is really a sharp decrease from the 31% growth in Q4 of 2021. And even a year ago, when earnings growth was 52% in Q1 of 2021. So when you consider base effects, 4-decade high or 40-year high inflation, and the reduction of fiscal stimulus, you can really see why Q1 expectations for corporate earnings growth is muted. Typically, earnings do beat estimates, which I expect to be the case here. So if you go on that, you could expect maybe earnings growth there in the first quarter to come in, closer to 7%, but still relatively muted compared to the earnings growth that we experienced last year. Moving forward, there's a couple things that I'm really focused on this season, this earnings season, which I think are going to be very telling. Companies who are able to raise prices without hindering sales are going to be rewarded with solid price appreciation, pricing power. With high inflation is going to continue, even though it might slow down a little bit here the remainder of this year. Companies that have pricing power and the ability to raise prices are going to outperform. Furthermore, really focus on the forward guidance companies are going to be providing. Companies will be dealing with higher borrowing costs due to higher interest rates, higher costs due to inflation, higher wages as they try and attract new workers. And so what will companies have to say about the higher input costs, which is sure to shrink margins? Baseball glove. I need to break it in. It's relatively new, so maybe I should wear it more often. But baseball is back, and I'm very thankful for that. I have grown to really enjoy baseball as I age, and it seems like I'm aging very quickly. So my enjoyment of baseball is also growing pretty quickly. With that being said, I will very rarely sit and watch an entire baseball game unless it's, say, the World Series or Game 7 of a playoff series. A game is just too long. However, it is true when people say it's America's pastime. For me, there's a lot of symbolism with baseball. Number one, it signals summer is looming. Grills are hot. And I say grills are hot. Cold beer is flowing, and everyone's outside having a good time, enjoying the sunshine. And with that comes baseball. So with that being said, I think there's a big issue with baseball, and a lot of it has to do with the huge gap between the top payrolls and the bottom payrolls for teams. For example, the highest payroll is currently the Dodgers. The Dodgers have a payroll of $277 million. Meanwhile, the Oakland A's have a player payroll of $32 million, which is a 64% decrease from 2021's payroll. John Heyman of the New York Post tweeted this out about the A's payroll recently. In 1991, the A's payroll was $33 million. So 91 payroll is the same as it is today. And let's look at some other statistics. So by comparison, the average Major League Baseball ticket has increased from $9 in 1991, which if you adjust it for inflation was $13. Meanwhile, it's north of $20 today. The average labor unit cost for a US company in 1991 was 79 compared to today, which is 123. CPI, inflation, has increased an annualized rate of 2.43% since 1991. And of course, we always like to compare it to gas. The average price of a gallon of gas was $1.34, which was that was the highest price in 1991, compared to $4.20 today for a gallon of gas. So when you think about this, if you're trying to find a place where there is no inflation, where there's a lot of place, it's very hard to find, any parts of this economy with no inflation. All you have to do is look to the Oakland A's. It's amazing that, the popularity and with media and all the money flowing in the baseball, yet the A's still have the same, their payroll is the same as it was 1991. Now, of course, it's not a linear line. There are years where they have a higher payroll than others, but still, there's no inflation in the A's payroll. But come on, A's, do yourself a favor, do your fans, reward your fans, and put a competitive team out there, and let's pay some money. So I'm going to leave you with this. Well, I think attending a baseball game is really, it's a great family event that helps build memories. I didn't, as a kid, I didn't get to go to the many games as a kid. In fact, I think my son, who's 4, has been to more games, or my son and I have been to more games together than my dad and I when I was growing up. There's a lot to do with that. My dad was a dental technician and was a sole proprietor. So he didn't get PTO, and teeth didn't make themselves. He didn't get weekends off. So he worked a lot, and it was very hard for him to take a few hours off, nonetheless, a full day off, which growing up in the Northwestern Wisconsin meant in order to go to a Twins or Brewers game, which when you consider the drive and the game, it's a full day event, if not more. So it was very hard for us to go. We still went to a couple, and I still vividly remember them going to the Metrodome back in the day. And I think one of my favorite games was when the Twins were in the playoffs against the Toronto Blue Jays. The Twins lost, but I remember vividly going. I know exactly the restaurant that we went to when we ate, or when we drove to Minnesota. And I just remember sitting there, we were eating popcorn, and I don't think my dad and I said much during the game because it was just so loud. And I think we were just both, so appreciative and kind of in awe of being at that game with that atmosphere. It was a lot of fun. While not going to a game may not have been a big part of growing up in small town Wisconsin, playing baseball was. During the summer, my dad was always willing to grab his glove and play catch with myself or one of my sisters while flipping burgers or grilling steaks and drinking his gin and tonic or cold beer. Speaking of gin and tonics is one of my favorite summer drinks, but it's got to be good gin. I remember growing up, my dad, I would always steal a sip of his gin and tonic or beer, and I always thought his gin and tonic was just terrible. Tasted like pine needles. Well, going into the liquor cabinet, he was drinking like Phillips gin, and today I just still don't understand how he could handle drinking Phillips gin versus good gin. But there it is. So it seemed like, we always had friends over playing ball in our backyard. In fact, for a couple summers, we mowed a baseball diamond in our field behind our house so we could play in a bigger area. The games often consisted of myself, my sisters, our friends, and our dads. And why baseball may not have been my favorite sport growing up, some of my fondest memories of playing sports was with my dad or family and friends, was around baseball. It doesn't need to be going to a game, like I might be doing with my son, going to the Reno Aces or to a Twins game when we're back home. But the memories that we've built around baseball, just playing catch in the backyard, is one of the reasons why, you know, it is America's pastime. So with that, I am well over my time, but I would like to thank you, and I hope you enjoyed our very first episode of Adjusted for Risk. We are going to have many more with a lot of guests, very knowledgeable guests, and hopefully some entertaining stories and maybe some jokes along the way. So please feel free to catch our podcasts on your favorite platform where you watch your other podcasts. Like and share our YouTube channels, and also go to our website, which is a wealth of insights at 6,237 feet. Thank you very much, and have a great week, and we'll see you next week.